Anything mentioned in this video is not a recommendation. Always do your own research or consult a qualified professional before making investment decisions. So far, I have focused on demonstrating how I go about building a portfolio for financial independence as a UK investor. I have mainly used a hybrid taken from both J.L. Collins's book, The Simple Path to Wealth, and tweaked it to fit UK-based investors like myself by adding some insight from the book Investing Demystified by Lars Kroyer. In the accumulation phase, whilst working towards FI, this is about as simple as it gets. Basically, buy as many shares of a global tracker as often as possible, and then leave the stock market to compound and work its magic, keep a bit of cash on the sidelines to cover any emergency expenses. As the pot gets closer to 25 times your annual expenses, the wealth preservation phase is entered. Consider adding perhaps a 10 to 25% allocation to bonds to smooth the ride. Something like a UK government bond fund and/or a global bond fund and some cash for upcoming expenses should do the trick. For some people, asset allocation, rebalancing, choosing funds, etc. is too much hassle. They want to be able to buy just one fund and own it forever. Any of the finer details should be handled for them. This is where the Vanguard target retirement date funds come in. Vanguard offers a variety of ready-made portfolios that take the simple path to a whole new level. All you have to do is choose the appropriate fund and Vanguard will take care of the rest. This is the ultimate simple path to wealth. These funds offer a diversified global asset allocation in a single product, automatically rebalances the asset allocation for you and gradually dials down the equity exposure and dials up the bonds as you age, lowering the risk exposure as you approach retirement. This is known as lifestyling or the glide path strategy. Lifestyling is a sound theory and makes a lot of sense, especially if someone doesn't have the time, knowledge or temperament to manage their own investments. The TRFs are funds of funds, which means they hold a number of index funds within one fund, and as a result they are low cost and widely diversified. At the start of the investing journey, the funds are exposed to more risk by a higher allocation to equities, which is approximately 80%. As the retirement date gets closer and passes, the equity exposure gradually reduces, settling at about 30%, and bonds increase to around 70%, including both UK gilts and inflation-linked gilts, and global bonds hedged back to the pound. It's interesting to take a closer look at two of the TRFs at different ends of the journey, the Target Retirement 2065 Fund and the Target Retirement 2015 Fund. The 2065 option holds approximately 60% in global equities excluding the UK, and 20% UK equities, making up the 80% equity exposure. The remaining 20% bond exposure includes 14% global bonds hedged back to the pound and 6% UK bonds. The 2015 option has already passed the target retirement date and is currently allocated to around 65% in bonds and 35% in equities. The bond exposure now includes around 45% in global bonds and 20% in UK bonds, of which around 15% of the UK exposure are inflation-linked gilts. The TRFs have an ongoing charge figure of around 0.24%, more expensive than holding the underlying funds or some of the simple global trackers on offer, but this is probably justified as Vanguard are adding value by making asset allocation decisions and rebalancing the underlying holdings. How to choose the appropriate target date fund. In the target retirement fund section on the Vanguard website, there is a tool that allows you to select an age range and it will match you with the most appropriate fund. As you can see, I entered my age range and it has suggested that as I will be between 63 and 68 in the year 2055, I will choose the Target Retirement Fund 2055. So to summarise, there are a few negatives with the TRFs such as a slightly higher cost than if the portfolio were constructed of the underlying holdings. Also, there is a home bias contained within these funds. This is something to be aware of. I typically try to diversify away from the UK and my non-portfolio assets as much as possible, but neither of these negatives are deal breakers for me. I think the main positive of the TRFs are that Vanguard takes all the decision making away from you. Even with a simple index fund portfolio, there are a lot of decisions to be made. Asset allocation, fund choices, rebalancing, when to switch your allocation as you age, and by how much. Some people argue Vanguard's allocation is too aggressive. Others say it's not aggressive enough. To be honest, for me personally, I think Vanguard probably get it about right. But this is not to say that everyone can handle an 80% equity allocation, and it's important to understand your own risk tolerance or seek advice from a qualified advisor. Overall, for the ultimate hands-off investor, I'm a fan of the target retirement date offering from Vanguard, which is why I hold this fund within my pension. This may be an option to consider for someone who wants to set and forget a one fund strategy, have everything automated, and then get on with their life. As always, thanks for watching, and I'll see you next time.